Okay, good morning, everybody, and thank you for joining today's webinar on the Global Economic Outlook with Jonathan Ashworth. So my name is Tim Sutcliffe, and I'm part of the UK employers team here at ACCA. We work with corporate and BFSI clients across the UK, supporting the development of finance teams from the ACCA's professional qualification that many of you, I'm sure, have pursued, through to ongoing training to ACCA learning, and also sharing wider insights and research through reports and webinars like today's event. So I'm delighted to welcome you all to the first in a series of webinars that we're planning for our UK corporate and BFSI clients in 2026. Across the year, we're going to be covering a range of important topics, including the global economy, AI, and emerging technologies. So I'm going to hand over now to Jonathan, who's going to present his latest insights, and this will be followed by an opportunity for Q&A. Please do feel free to submit questions in the chat as we go along, and we'll do our best to address as many as we can afterwards. Over to you, Jonathan.
Fantastic. Thank you, Tim. Can you see my presentation now?
I've just popped it on screen, so it should be there now. Yeah, lots of thumbs up coming through, so you're good to go.
Well, thank you once again for attending the presentation today on ACCA's 2026 Global Economic Outlook, titled Steady but Fragile Global Growth. I'm going to speak for around 30 minutes, then we'll move on to Q&A. 2025 was a monumental year for international trade and the global economy. As you can see from this chart, the United States increased its average effective tariff rate from around 2% in 2024 to around 17% at the present time, which is the highest rate since the 1930s. But despite the major disruptions in global trade, the global economy proved much more resilient than expected in 2025. And this is well highlighted by the chart, which shows the progression of the IMF's forecast for global growth and global trade growth since the beginning of January 2025. The red line shows the IMF's forecast for global growth in 2025, and the turquoise line shows the IMF's forecast for global trade growth in 2025. You can see forecasts for both fell sharply in April 2025, just after President Trump had announced a big increase in tariffs. But by October of last year, the forecasts for both global growth and global trade growth were broadly similar to the forecasts made in January of 2025, which was just before the inauguration of President Trump. And by January of this year, the IMF was actually forecasting global trade growth in 2025, which was faster than they'd initially assumed a year earlier. So the global economy proved much more resilient than expected. And there are a number of different factors to help explain this. Most countries didn't retaliate against President Trump's tariffs, so we avoided a tit-for-tat style trade war like we saw in the 1930s. Many countries also front-loaded their exports to the US to get ahead of the likely tariff increases. And at the same time, President Trump enacted tariff pauses on many countries, which helped calm global financial markets, which initially fell very sharply. And the US subsequently agreed trade deals and trade truces with many countries, which was a really important development. In addition to this, the impact on US inflation of tariffs was much less than expected, which meant there was a far lesser shock to the US consumer. And still pretty decent US inflation allowed the Federal Reserve to cut interest rates last year to help support the economy. And just lastly, we had the ongoing global AI boom last year, which was a key major support to the global economy. Despite the resilience we saw with global growth, our latest survey of global accountants suggested accountants were quite downbeat and cautious at the end of 2025. Every quarter since the end of 2011, we've run a quarterly survey of global accountants. And this chart shows the key indicators from that survey. And I won't go into too much detail, but the dark blue line shows the global confidence index. And as you can see from the right-hand side of the chart, confidence amongst global accountants was largely unchanged in the final quarter of 2025, but it remained at a very low level by historical standards. And this probably reflects the significant uncertainty still lingering in the global economy, and also the wide array of risks at the present time, which are more firmly skewed towards the downside. We also ask accountants about the level of cost pressures at their firm every quarter. And I won't go into too much detail here, but if you look at the blue bars on this chart, this shows the proportion of accountants reporting increased operating costs in each region in the fourth quarter of 2025. The turquoise circle shows the median reading over the survey's history. And I think there are a few important takeaways from this chart. If you look at Western Europe, cost pressures still remain very elevated at the present time. And that's being driven by intense cost pressures at firms in the United Kingdom. Cost pressures are also meaningfully above average, according to accountants in North America. And the negative impact of tariffs looks to be a factor here. In all the other regions of the world, cost pressures don't look particularly worrying at the present time, and they're broadly similar to what they've been historically. In a quarterly survey of global accountants, we also asked them what their top risk priorities are at the present time. And this section's done by a colleague of mine called Rachel Johnson. The red bars on the chart show the survey responses for the fourth quarter of 2025. And you can see the top ranked risk, unsurprisingly in the fourth quarter, was economic related risk. And that was cited by around 18% of respondents as the top risk. But that was closely followed in second place by risks related to cybersecurity. And this risk has increased in prominence over recent quarters, as you can see from the chart. In third place were regulatory and compliance risks. Then that was closely followed in fourth place by international and geopolitical instability. Moving away from our survey of accountants, on a central case scenario, I think a steady global expansion seems likely in 2026, although it is quite a fragile economic backdrop. For reference, I've included the World Bank's latest economic forecast in the table. The World Bank's forecasting global growth of 3.1% this year, slightly lower than the 3.3% expansion in 2025. The IMF is forecasting global growth largely unchanged at 3.3% in 2026. And this is quite a decent pace of global expansion, albeit it's slower than the 3.7% average we saw in the decades before the global pandemic. I think in terms of the key drivers of growth this year, the global economy should benefit from the significant monetary easing we saw by central banks in 2025, as easier monetary policy works its way through the global economy. And I think importantly, fiscal policy is likely to become easier in a number of key economies this year. In the United States, the One Big Beautiful Bill Act was passed in 2025, and that includes tax cuts for consumers this year and also incentives to improve business investment. The Congressional Budget Office in the United States forecasts that the One Big Beautiful Bill Act should boost growth in the US by around 0.9 percentage points this year, which is quite a sizable boost. And fiscal policy is also likely to become materially more supportive in Germany and Japan this year, the world's third and fourth largest economies, respectively. And fiscal policy should remain very supportive in China, the world's second largest economy. In addition to this supportive policy backdrop, the global economy should continue to benefit from the ongoing global AI boom. And it also should benefit from some reduction in policy uncertainty compared to what we saw in 2025. Just to look at the world's major economies, if you look at the left-hand side chart, this shows the 3-month moving average change in private employment in the United States. And you can see there was quite a slowing over 2025. And this had raised the fears about the risk of a US recession, because people were worrying that a slow pace of hiring could potentially switch to firms beginning to lay off workers on a large scale. And that would create a vicious circle, raising the risk of a recession. But overall, the labour markets remain quite soft in the United States, but it's not deteriorated significantly. It's remained broadly stable if we look at a large measure of indicators. Hiring's quite low, but we're not seeing a massive pickup in layoffs. The labour market's broadly stable. And I think that's eased fears about a risk of a recession in the United States. And indeed, economic growth in the US has remained pretty robust over recent quarters. If you look at the right-hand side chart, the red bars show the quarterly change in US GDP growth. In the first half of last year, there was quite a bit of volatility in the quarterly numbers, but average growth in the first half of last year was just under 2%. But if you look in the third quarter, the US economy grew a very robust over 4%. And in the fourth quarter of last year, the average of the forecast models from the Atlanta and New York Fed are pointing to the economy expanding by over 3%. So the US economy is expanding pretty strongly at the present time. And one key support has been the ongoing resilience of the US consumer. The turquoise bars show the quarterly change in US consumer spending, and it increased by over 3% in the third quarter of last year, and tracking estimates point to another strong increase in the fourth quarter. And this ongoing resilience of the US consumer has come despite the fact that consumers are telling pollsters that they're quite gloomy at the present time. The left-hand side chart shows US consumer sentiment, and it's still at quite low levels by historical standards. And I think one factor that's been supporting the consumer spending has been that ongoing AI boom, because it helped lift stock markets to record highs last year, and it boosted the wealth of high income and wealthier Americans. And it was their spending that kept consumer spending growth pretty solid last year, at a time when lower income consumers faced more pressure. And the AI boom has not just been supporting consumer spending, it's also been boosting business investment. The right-hand side chart shows the year-on-year change in business investment in information processing equipment and software. And on the latest available numbers for the third quarter, investment in this area was increasing by around 15% on a year-on-year basis. And you're also getting heavy investment in things such as data centers. Overall, the US economy increased by over 2% in 2025, and growth in the region of 2 to 2.5% seems likely in 2026, most likely at the top end of that range. And I think there are some potential upside risks for the US economy. I think overall, as I mentioned, fiscal policy will be supportive. Recent rate cuts by the Fed should support the economy. And there's a risk of perhaps some additional modest monetary easing once we get the new governor, Kevin Warsh, in place in June. And the US should also continue to benefit from the AI boom. And I think also importantly, the US president's got really important congressional elections in November, and he does not want to lose the House of Representatives. So I think we'll see the US administration doubling down on efforts to try and boost the economy over coming quarters. And we may also see President Trump show more restraint on some of his policies that have unsettled businesses and investors over recent quarters. Turning to the world's second largest economy, China, the economy expanded by 5% last year, hitting the government's growth target. And exports were a key driver of China's growth, despite the large increase in US tariffs. If you look at the left-hand side chart, this shows the change in Chinese exports by region in 2025. And what you can see, exports to the US fell very sharply by 20%. But this was more than offset by strong export growth to other regions, such as Africa, the ASEAN bloc, the EU, and to a lesser extent, Latin America. And Chinese exports in high value-added areas, such as cars, shipbuilding, and semiconductors, increased very, very strongly last year. And China's goods trade surplus was at a record level in 2025. And this export strength allowed industrial production to continue to rise at quite a rapid clip in 2025. But despite this external strength, the domestic economy in China looks much weaker at the present time. The left-hand side chart shows the year-on-year change in Chinese retail sales. And that had slowed just to 0.9% in December of last year. And if you look at the right-hand side chart, this shows the cumulative year-on-year change in Chinese fixed asset investment. And this actually contracted in 2025 for the first time in a number of decades. I think the problem for the Chinese domestic economy is the ongoing issues in the housing market. This is continuing to weigh on consumer confidence, and it's continuing to hit consumer spending. And property-related investment continues to fall very, very sharply. And that's weighing down on fixed asset investment. And in addition to this, the government's been trying to push back on overcapacity in a number of manufacturing sectors, because that has been leading to cutthroat price competition, which has been increasing fears about the risk of a Japanese-style deflationary spiral. And this pushing back by the government on overinvestment also looks to have weighed down on private sector investment, which has been another factor weighing on overall investment. Overall, in 2026, the IMF and World Bank expect some moderation in Chinese growth to around 4.5% this year. And there's been some speculation that the Chinese government may actually reduce its growth target from around 5% in recent years to a range of between 4.5% to 5% for 2026. And any such change will be announced at the National People's Congress in March. I think potential downside risks to Chinese growth this year include perhaps other regions and countries increasing trade restrictions against Chinese exports. And the housing market also remains a downside risk for China. I think upside risks for China could come if the government was to pivot to more aggressive policy easing, although that doesn't look to be in the offing at the present time. Global outlook, we also included an interview with renowned China-based business writer and columnist Wu Chen. He saw a two-speed global economy in 2026, with the high-speed part being AI. He suggests the low-speed part in the US and West will reflect affordability issues, while in China it will be the result of continued structural problems. He highlighted the struggling real estate market, an increasingly challenging job market for younger graduates as firms increasingly apply AI in the workforce, and he also pointed to the weak household disposable income growth. He argues that instead of supply-side reform, China needs demand-side reform and to raise the low share of consumption in its economy. Moving to the world's third largest economy, the euro area, the economy showed a fair bit of resilience last year despite the increase in US tariffs. It expanded by 1.5%. And a key support to the euro area economy is the continued resilience we're seeing in its labour market. You can see the unemployment rate on the continent still remains close to record lows at the present time. And with inflation falling sharply, this has meant that households have been benefiting from quite decent positive real income growth, which has been supporting consumer spending. And the fallback we've seen in inflation on the continent has also allowed the European Central Bank to cut interest rates quite aggressively over the last 18 months, as you can see from the right-hand side chart. And that's obviously quite supportive for households and businesses. In 2026, I think growth of just over 1% seems likely in the euro area. And I think the easier monetary policy will be a key support, as will be slightly easier fiscal policy, particularly in Germany, as the country steps up its spending to improve its defence capabilities and also to improve the country's infrastructure. But I think downside risks in the euro area could come from the higher US tariffs as they work their way through the economy. They could also come from a stronger euro and also from increasing competition from China in a number of key industries. Turning to the United Kingdom, if you look at this chart, the red line shows the confidence index from accountants from our quarterly survey going back to 2011. And what you can see is that confidence amongst accountants still remains very, very low at the present time. The latest reading was in the fourth quarter of last year. And a key problem is those intense cost pressures. The turquoise line on the left-hand side axis shows the percentage of respondents reporting increased operating costs. And you can see this is still close to record highs for the series. And I think, in truth, confidence amongst UK-based accountants doesn't look to have properly recovered from the large increase in employer national insurance contributions, which were enacted by the Chancellor in 2024. That being said, on a positive note, some of the other business confidence surveys that we've seen in January of this year do suggest that confidence amongst UK businesses is beginning to improve as we've moved on from the uncertainty of the last budget. So that's a positive development to watch going forward. And I think in addition to this, despite still elevated domestic cost pressures, I think given a weakening labour market and a still sluggish economy, I do think we're likely to get some additional interest rate cuts from the Bank of England this year. Probably 2 rate cuts, perhaps 3 rate cuts, which should help support the economy. And inflation in the UK is likely to fall back to the Bank of England's target this year, which should also be quite helpful for business and consumer confidence. Overall, I think the UK economy is probably going to expand by around 1% this year. Positive, but still quite sluggish economic growth. The final economy I want to quickly point to is India. India suffered a major shock last year when the US unexpectedly raised tariffs on its exports to 50%. But the Indian economy proved much more resilient than expected last year, growing at a year-on-year rate of 8% in the latest available data. And it's benefiting from a robust consumer at the present time, amid very low inflation, some good crop seasons, and due to monetary easing by the central bank. And I think in 2026, India should remain the world's fastest growing major economy, supported by robust consumer spending growth, solid investment in infrastructure by the government, and due to fast growth in its services sector. And I think on an optimistic note, pressure from the increase in US tariffs, the government in India enacted a number of economic reforms last year, including to the labour market. And I think the result of these reforms over time could be a stronger and improved economic performance in India. And we've also had some good news on top of this on the trade front. India signed a trade agreement with the EU in the previous week, and it's agreed finally a trade deal with the United States. Some really positive developments. And I think the mood music is improving around India's growth prospects, given recent developments. I mentioned earlier that I expect steady, decent global economic growth this year, but I did highlight it's a fragile global backdrop amid elevated uncertainty and a wide array of risks, which are primarily on the downside. Just to highlight a few of these, I think geopolitical risks are going to remain front and center in 2026. Even before the intensification of geopolitical issues in January, with developments in Greenland, measures of geopolitical risk were elevated compared with the average of recent decades. In addition, I've highlighted that the AI boom has been a key support to the global economy, but those huge gains in technology stock have raised fears about the risks of an AI bubble, similar to the dot-com bubble. And you can see one of the reasons behind these fears, that stock markets are looking quite expensive at the present time, particularly in the United States. This is a commonly watched stock market valuation measure called the cyclically adjusted price earnings ratio. And you can see that valuations are at the highest level since the dot-com bubble, and even higher than in the time of the Wall Street crash in 1929. So I think, fears of an AI bubble are a key risk. I think over the next 12 months, if all the investment in AI begins to show signs of boosting productivity at US firms, I think fears of an AI bubble could recede. But in the converse, if we don't see much concrete evidence that all this AI investment is boosting productivity at firms, I think the risk could increase of quite a large market correction. So I think that's something that needs to be watched closely. In addition, I think developments in advanced economy bond markets also need to be watched very carefully. This chart shows 30-year and 10-year US Treasury yields, and they back it up at levels we saw before the great financial crisis. If we were to get a significant move higher in US Treasury yields this year, that could be quite negative for global financial markets, the global economy, and it would also increase debt servicing costs for governments around the world. Potential triggers of a material move higher could be renewed investor concerns about debt sustainability in the US and other advanced economies, Also, if fears began to build about threats to the Federal Reserve's independence, that could be a catalyst. In countries like the UK and France, increased political instability could push up government bond yields. And also, we need to watch developments in Japan very carefully. In recent decades, Japanese investors were large investors in government bonds in other advanced economies because interest rates were very low in Japan. But with the central bank in Japan beginning to increase interest rates, there's a risk that Japanese investors could increasingly begin to favor investing in their home bond market, which could push up bond yields in other advanced economies. And there's always a risk that this move by Japanese investors could happen in quite an abrupt fashion. So developments in Japan need to be watched carefully this year, and they could potentially have large impacts on global financial markets. The last downside risk I want to highlight is global trade tensions. This chart shows an index of US trade policy uncertainty, and it's well down from its peak, but it's still quite high by historical standards. And President Trump's recent threats to raise tariffs on Europe over Greenland just highlight the risk that we could get an escalation again in global trade tensions this year. And I think we need to watch carefully developments with the US and China trade truce, which is due to end in November. But just to highlight again, I don't think we can rule out upside scenarios for the global economy this year. And the US could potentially be a driver of this, particularly if tariff-related inflation remains muted in the US, and if monetary and fiscal stimulus begins to fuel a strengthening in the US labor market. And as I mentioned earlier, the US administration is likely to double down on policies to try and boost the economy ahead of the midterms. And one final important point I want to make about the US economy: productivity growth has been relatively strong in the US over the past several years, and it's been notably robust in the last few quarters. Remember the charts I showed earlier? You've had really strong GDP growth over recent quarters, despite quite slow increases in US employment. And this strong increases in productivity growth has allowed the economy to expand quickly, despite the relatively weak labor market. If we begin to see clear evidence this year that AI investment is beginning to raise US productivity growth meaningfully, that could really boost global financial markets. And it would likely fuel an acceleration in business investment in a number of countries. Just to quickly highlight the key events in 2026, I'll run through this super quickly. In March, we've got China's National People's Congress. That needs to be watched very carefully. We'll hear about the government's growth target for the year and also the stance of its fiscal policy. In April, President Trump's expected to visit China, and that will be watched carefully. In June, we have the first meeting of the new Federal Reserve Chair, Kevin Warsh. And to end the year, we've got US midterm elections in November. And President Trump does not want to lose the House of Representatives, because that would constrain his policy room for maneuver in the second half of his term. Last but not least, in the Global Outlook, I had the honor of interviewing Harvard professor and former IMF chief economist, Ken Rogoff. And just to summarize his latest views, he suggested that the global economy was solid, but not exciting. And he argued that the huge uncertainty is not reflected in financial markets to the extent it should be. He warned of a big stock market fall at some point over the next 3 years, but acknowledged the market could go up significantly before falling back. Despite the surprisingly positive economic picture, given where it seemed we were 6 months ago, he saw downsides to President Trump's policies on trade and immigration. and he thinks the negative consequences for the US economy are likely to be felt in 2027 and 2028. As regards AI, he is cautious about its impact on the economy, and he warns that there's every possibility that we see a bigger backlash against it than we saw with globalization. He expects the US dollar to remain the world's dominant currency, but thinks its market share will shrink over time, with a currency like the Chinese renminbi increasing in importance. And finally, he argues that the odds of a US fiscal crisis happening within 4 to 5 years is more likely than not, although he acknowledges that a shock may be needed to set it off, such as another pandemic or some type of financial crisis or a major geopolitical event. So, to conclude, on a central case scenario, the global economy looks set to expand at a pretty reasonable pace in 2026. But it's a fragile and volatile backdrop amid a wide array of risks, which are primarily on the downside. The US economy looks to be the strongest performer amongst the major advanced economies, while growth will be positive but sluggish in the UK and Euro area. Growth in China is generally expected to moderate this year, while remaining faster than the global average. India should remain the world's fastest growing major economy this year, and recent reforms could help improve its longer term economic performance. All in all, in a world of heightened uncertainty, businesses should continue to hope for the best, but prepare for the worst. Thank you. And just to highlight in my presentation, I've included a link to an interview I did with on AI with 2024 Nobel Prize winning economist Simon Johnson, just in case any of you are interested in watching that. Thank you very much.
Brilliant, Jonathan. Thank you ever so much for sharing your insight with us and bringing your report to light. I see lots of claps coming through, so I think that's been very well received. We have got a couple of questions coming in, and indeed I did open up when people registered the opportunity for people to ask questions as well. So we'll start working through some of those. So well, you mentioned him a couple of times during your report and your presentation, not a huge shock. Kevin Walsh, new US Federal Reserve Chair, picked and announced by Trump recently. How do you see his arrival impacting US monetary policy in 2026?
Interestingly, Kevin Walsh was previously a Fed governor between 2006 and 2011, and he was typically on the more hawkish side of the debate regarding inflation, and he was less in favor of QE after the great financial crisis. So he was on the more hawkish side, and obviously that's not what President Trump wants. But over the last year or two, he sounded more dovish in terms of monetary policy. He's talked about the need for interest rate cuts in the United States. Perhaps in part that may have been him in auditioning to try and get the Fed chair job. But overall, he's been arguing for rate cuts. So I think he will probably be a bit more dovish. And I think it increases the risks that we could get some additional rate cuts from the Fed this year once he's started as Fed chair. But I think it's important to stress that he needs to be able to persuade a majority of the committee to go along for him. So if the economic and inflation data doesn't allow, he may not be able to persuade a majority of the committee to vote for a rate cut. But central case scenario, I think it increases the probability that you will get a bit of interest rate cuts from the Fed this year, 1 or 2 rate cuts most likely.
Great, thanks, Jonathan. And sticking with the US then, what do you think of the prospects for the US dollar this year? Is the currency at risk of losing its reserve currency status?
I think in terms of the US dollar this year, well, think if we look at the monetary policy of the other major economies, the ECB looks like it's going to be on hold this year. It's cut interest rates quite significantly. It's suggested that interest rates are in a nice place. So I think the likelihood is we're not going to get any monetary easing from the ECB. Risk is you could perhaps get a little. In Japan, the other major central bank, they're going to be cautiously increasing interest rates. While in China, at the margin, you may get a bit of modest rate cuts. And we've seen Australia raise interest rates this week. So I think the upshot is you're probably going to get more monetary easing from the Federal Reserve than the other major central banks. So all of the things being equal, I think that should put some additional downward pressure on the US dollar, most likely to weaken against the other currencies. And President Trump seems to be in favor of some further weakening of the US currency as well. So I think it seems most likely. In terms of, is it at risk of losing its reserve currency status? Obviously, that's been something that's been getting a lot of attention with President Trump's increase in tariffs and the geopolitical moves by the US. I think at the present time, it is likely to remain the world's reserve currency for the foreseeable future. It's still got the key attributes: the massive economy, the deep and liquid global financial markets, the rule of law is still holding in the US. It's got the open capital account. And there's no other currency that's got all those challenges. So I think it is likely to remain the reserve currency for the foreseeable future. But I would agree with Ken Rogoff's views. I think its dominance will reduce over time. I think the euro will become slightly more important. And I do think the Chinese currency is likely to become more important over time. One point Ken Rogoff has made, and I think it's a really good point, over time, the Chinese authorities probably will want the renminbi to be less tied to the US dollar. And given that so many Asian countries trade heavily with China, once the renminbi becomes less tied to the US dollar, you're probably going to see Asian currencies become less tied to the US dollar as well, and they'll become more closely tracking to the Chinese renminbi. So I think over time the renminbi will become more important, but dollar will remain the main currency.
Okay, great. I guess we talked a lot about America. This is quite an interesting question, this one that's come in. So when, if not already, will we truly live in a multipolar world? So that's where the US dominates the West and China the East. Is this the most likely scenario, or is there an alternative view? And also saying, sort of, will crypto and digital currency, will that potentially play a role in that?
Well, that's a really good question. I think in many ways we're already in a multipolar world. Given the significant increase in the importance of Chinese economy we've seen over the last 10 years, we've already moved to a multipolar world to some extent. And I think over coming decades, we'll move even further on that journey, given the growing importance of Chinese economy, and as India increases more and more as a large economy as well. So I think the directions, certainly in terms of further multipolarity, I think and there's a question there about the US dominating the West and China dominating the East. I think obviously, yes, the US will continue to dominate in the West. I think in the East, China's importance will continue to rise, although I wouldn't necessarily see the US completely withdrawing from the East, given the continued economic importance of that region. But I think the big answer is yes, we are moving to a more multipolar world. And I think on the question of cryptocurrencies, I think a lot of focus at the present time is on stable coins. The US administration's really in favor of stable coins. It's been really supportive of them. And there are various reasons for this. And they could be very supportive of maintaining the dollar's role as the world's dominant currency. I think in general, There are potential real positives for stable coins in the future. They could increase the speed and reduce the cost of international payments. They could potentially increase competition in domestic payment markets as well. So we are likely to see continued growth in stable coins, particularly US dollar-backed stable coins. But I think importantly, regions like the EU and China won't want to allow massive growth in US dollar stable coins in their economies. So they'll want to continue to promote their own central bank digital currencies because they won't want to lose control, of their domestic monetary conditions. So you'll see big growth in US dollar stable coins, particularly in the US, but the authorities in some of the other major economies won't want to allow US stable coins to grow significantly in their countries and regions.
And the next question we've got, Jonathan. You did kind of touch on this a little bit already, but how do you see AI impacting economies over the coming years?
Yeah, that's a really good question. Anyone answering this question shouldn't try and sound excessively confident, given the huge amount of uncertainty in this. I'd be in the camp that AI will be able to boost productivity growth decently over the next 10, 15 years. But it is difficult to be precise about how big the impacts will be and when we'll see the impacts of those boosts. And it's important to stress as well that you're going to get wide differentials across economies. Advanced economies with the infrastructure and skills are likely to benefit more from the AI adoption than developing economies. So it could increase the divide between the advanced world and the developing world. And ultimately, there's still big uncertainty about the impacts overall of AI. I talked about I mentioned the interview I did with Simon Johnson last year, and he highlighted the fact that historically, big technological breakthroughs have not always benefited the majority of the population. Sometimes they have, like with railways, but in other instances, they've not. So he was making the point, it's going to be really important that policymakers take steps to try and ensure that AI complements workers rather than just being a substitute for workers. So overall, I'm relatively positive, but I think there's risks, and policymakers need to try and steer AI adoption so it supports the economies rather than just substituting for workers.
Okay, so we just got one question left. I don't think we've had any others come in. So if anybody does have another question for Jonathan, we've got sort of 5-10 minutes. So just pop it in the chat and we can get to it next. Final question for you, Jonathan. So is in a time of high economic and business uncertainty, they reference fluctuating tariff levels, sanctions, how best can businesses manage their risk?
Yeah, that's a good question. I want to be a little bit humble about answering that question, given I'm an economist and I've never really ran a business myself. But I think, looking at it from the high-level economist perspective, given all these geopolitical and trade uncertainties we've seen over recent years and the shocks like the pandemic and things like that, my advice as an economist is just, where possible, ensuring you've got as much diversification in your business as possible, both in terms of your suppliers and also in terms of your end customers, given, this seems to be a global economy that keeps getting buffeted from the shocks. And obviously, the point I concluded on my presentation, hope for the best, but, just have some preparation for some of the worst case scenarios if they come along.
Okay, great. So, yeah, prepare, plan, think ahead, prepare for the worst, but also make sure you're diverse as well in terms of what you're doing. So, yeah, I don't think we've had any other questions come in. So no, I don't think so. So first of all, Jonathan, thank you ever so much for the report that you've written, and then taking the time to come in today and share your insight and answer questions for our UK clients in the corporate and BFSI sector. We really appreciate it. So thank you for that. In the chat, I have dropped access to Jonathan's full report. So if you want to download and look at the PDF of that, you can do that. It's in the chat. I've also put a link to the next webinar that we're going to be running for you. So that's on the 24th of February at 11 a.m. That is Navigating Ethics in the Age of AI. So we've got Alistair Brisbane, who is the head of technology at ACCA, and Sarah Lane, who's head of ethics and assurance at ACCA. They're going to be joining us for that session. So if you found Jonathan's insight useful, if you're starting to see there are lots of interesting research that ACCA is doing, please do come and join us for that next event. We will send some information to you after the session, so do look out for that. If there's anything you think that ACCA might be able to help your organisation with in terms of the development of your finance teams, in terms of learning more, perhaps getting involved in some of the research that we're doing, then we'd be absolutely delighted to hear from you. Final check. No other questions have come in. So yeah, just a final thank you, Jonathan, for today's session. And thank you to everybody for attending. And we look forward to hopefully seeing you at one of our next events.
Thank you so much for attending, everybody.